Your money-making broadcast starts now. Good evening. It is Wednesday, May 27, 2026, and this is Canada Econ Pulse. Tonight we have a packed agenda. Markets delivered a mixed picture as oil prices suffered a sharp decline on Iran peace rumors, the Russell 2000 continued its blistering weekly rally, and Canadian investors are watching Salesforce earnings after the bell for clues on enterprise software demand. Let us break down exactly what this means for your portfolio from a practical Canadian perspective. We start with the closing numbers from North American markets. The S&P 500 closed at 7,520.36, essentially flat at plus 0.02%. The Nasdaq Composite finished at 26,674.73, gaining 0.07%. The Dow Jones Industrial Average outperformed the other major indices, reaching 50,644.28 for a gain of 0.36%. These moves tell us that capital was rotating away from pure tech toward more cyclical and value-oriented names. The standout story across the board was the Russell 2000 Small Cap Index. The IWM ETF that tracks it settled at $290.37. While today's session saw a modest decline of 0.05%, the weekly gain is an eye-popping 5.3%. That is the kind of explosive move that gets institutional attention. This is precisely the bull broadening that value-oriented investors have been anticipating for months. When small caps rally this hard, it sends a powerful signal that institutional capital is no longer willing to chase mega-cap tech at extreme valuations. Instead, money is rotating into the parts of the market that have been left behind. For Canadian investors, this is especially meaningful because the TSX is heavily weighted toward financials, energy, materials, and industrials. A broadening U.S. rally typically pulls Canadian equities higher as well. The VIX, Wall Street's fear gauge, dropped 4.23% to 16.29. A VIX below 17 signals that options traders are not pricing in significant downside risk. While that is supportive for risk assets in the near term, it also means there is very little hedging activity, leaving markets vulnerable to sudden volatility spikes. On the ETF front, the SPY closed at $750.46, the QQQ at $729.45, and the DIA at $506.88. Canadian investors can use these as proxies for U.S. sector exposure. For TSX-specific tracking, the IWM serves as a useful small-cap momentum proxy that often correlates with Canadian small caps and the TSX Venture Index, especially during risk-on periods. Now let us turn to the dominant story of the day, oil. Crude prices crashed 4.36%, driven by renewed diplomatic signals suggesting potential progress in Iran peace negotiations. For Canadian investors, oil is a double-edged sword. Canada is a major oil exporter, and the TSX carries significant weight in energy producers like Suncor, Canadian Natural Resources, and Cenovus. A sustained drop in crude would pressure energy-heavy portfolios and weaken the Canadian dollar against the US dollar. However, the flip side is that lower oil prices mean lower input costs for airlines, cruise operators, manufacturers, and consumer-facing businesses. The negative correlation between crude prices and discretionary travel stocks is well documented, and today's action confirms this dynamic is alive and well. The market is now on day 33 of a persistent bull run, and the technical indicators are flashing caution signals. The relative strength index on the S&P 500 sits at 71, while the Nasdaq is at 75. Both readings are in overbought territory, meaning the probability of a pullback or consolidation phase is elevated. The QQQ RSI is even more extended. When markets become this stretched, they become vulnerable to sharp reversals on any negative catalyst. The upcoming core PCE inflation data scheduled for release on Friday is exactly that kind of catalyst risk. A hotter-than-expected reading above 0.3% month-over-month could trigger a sell-off in growth stocks that would ripple into Canadian tech and growth names trading on the TSX. Big Story 1, the oil crash and its Canadian implications. The 4.36% drop in crude is the defining macro event of the week. The catalyst is diplomatic. Reports emerged that Iran peace talks are progressing, which would remove a significant geopolitical risk premium from oil prices. For Canadian energy investors, this is a near-term headwind. The TSX energy sector has been a relative outperformer this year, and a correction in crude could trigger profit-taking. However, for the Canadian economy as a whole, lower oil prices act like a tax cut for consumers and businesses. Every Canadian household benefits from lower gasoline prices, and every transportation company benefits from lower fuel costs. The travel and leisure sector is the clearest beneficiary. Carnival Corporation, trading on the NYSE under ticker CCL, closed at $27.98. The crude crash is a direct tailwind. Fuel represents one of the largest operating expenses for cruise lines, and every dollar decline in crude oil prices flows through to improved profit margins. Travel demand remains robust, with booking volumes exceeding pre-pandemic levels across the industry. For Canadian investors, CCL offers a way to bet on both the consumer resilience theme and the oil crash trade simultaneously. Big story 2, bull broadening and the small cap inflection. The Russell 2000 gaining 5.3% in a single week is not a random fluctuation. It represents an inflection point in market psychology. For the better part of 2 years, the U.S. equity market rally has been concentrated in a narrow group of mega-cap technology stocks. The so-called Magnificent Seven names dominated index returns while the average stock lagged. That dynamic is now reversing. When the IWM breaks through its upper Bollinger Band and hits 52-week highs, it confirms that institutional money is rotating out of crowded tech trades and into neglected areas of the market. For Canadian investors, this rotation is especially constructive. The TSX does not have a Magnificent Seven problem. Canadian index returns are more evenly distributed across sectors. Financials, energy, materials, and industrials all carry meaningful weight. When the U.S. market broadens, Canadian equities tend to participate more fully. The TSX Venture Index, which tracks smaller Canadian companies, is particularly sensitive to this kind of risk-on rotation. Big story 3, semiconductor cycle confirmation. Micron Technology, trading as MU, jumped 3.6% to $928. This is a critical signal for the artificial intelligence semiconductor cycle. When a memory chip manufacturer with significant exposure to data center demand rallies this hard, it confirms that the AI infrastructure build-out is continuing at a rapid pace. For Canadian investors, this has direct read-through implications. Companies in the semiconductor supply chain, including AMD and Broadcom, benefit from the same secular demand drivers. The AI capex cycle is not slowing down. Every hyperscale cloud provider is still spending aggressively on data center infrastructure, and that spending flows through to semiconductor companies across the value chain. The significance of MU's move goes beyond just the AI trade. Memory chips are a leading indicator for the global electronics cycle. When memory demand picks up, it typically signals that the broader technology hardware cycle is accelerating. This is bullish for Canadian technology stocks that supply components, materials, or software to the global electronics industry. Canadian Stock Spotlight. Let us turn to 3 names that matter for Canadian investors today. BlackBerry, ticker BB.TO on the TSX, closed at $11.99, gaining 2.9% on the session. The stock is approaching $12 resistance, a level that has capped upside in recent months. For investors following a value-oriented approach, BlackBerry remains an interesting turnaround story. The company has pivoted away from its legacy smartphone business toward cybersecurity software and the Internet of Things. Its QNX operating system is embedded in millions of vehicles worldwide, giving it a niche in the growing automotive software market. At $11.99, the stock trades at a fraction of its former highs, but the underlying business is more focused and potentially more valuable than it was during the smartphone era. Canadian Pacific Kansas City, CP.TO, traded at $126.24. Railways are defensive infrastructure assets that offer steady cash flows and exposure to North American trade flows. CPKC is the only railway with direct service connecting Canada, the United States, and Mexico, making it a unique beneficiary of nearshoring trends. For Canadian investors looking for a core portfolio holding with a moat, CP.TO at $126.24 offers a reliable income stream and long-term appreciation potential tied to continental trade growth. Fairfax Financial Holdings, FFH.TO, closed at $2,171. As an insurance and investment holding company led by Prem Watsa, Fairfax provides a defensive anchor for Canadian portfolios. The insurance business generates float that Watsa deploys into undervalued assets across global markets. Fairfax has a strong track record of outperforming during downturns. In an environment where the broader market is overbought and inflation data looms, FFH.TO offers portfolio insurance without needing to buy expensive put options. Portfolio strategy, the Druckenmiller Playbook. Your current portfolio shows a 74.5% cash allocation. This is a defensively postured stance that echoes the approach of legendary macro investor Stanley Druckenmiller. Druckenmiller is known for holding large cash positions when risk-reward is unfavorable and deploying capital aggressively when dislocations appear. He does not force trades. He waits for the proverbial fat pitch. In the current environment, with the VIX below 17, RSI readings across major indices in overbought territory, and a pivotal inflation data point arriving on Friday, maintaining a high cash buffer is the right call. Druckenmiller's philosophy is particularly relevant this week. He famously said that the key to great investing is not how much you make when you are right, but how much you lose when you are wrong. By keeping 74.5% in cash, you are protecting your portfolio from the asymmetric downside risk that a hot PCE reading would trigger. If Friday's data comes in benign and the market rallies, you can deploy that cash into positions that are still trading at reasonable valuations. If the data comes in hot and the market sells off, your cash gives you the ability to buy the dip at better prices without being forced to sell into weakness. Recommended stock lineup for Canadian investors. Now let us move to specific recommendations for tonight's broadcast. These are for actionable ideas that span different risk profiles and investment philosophies, all priced at or below $35, making them accessible for Canadian retail investors building diversified portfolios. Safe allocation, Pfizer at $26.21. Pfizer, ticker PFE, trades at $26.21. This defensive pharmaceutical pick is inspired by the global value investing approach of Sir John Templeton. Templeton built his legendary track record by buying undervalued assets with global demand during periods of maximum pessimism. Pfizer fits this mold perfectly. The stock trades at a discounted valuation relative to its historical average and offers a dividend yield that Canadian income investors can appreciate. The global demand for healthcare products and pharmaceuticals is non-cyclical, meaning Pfizer's revenue stream remains stable regardless of the economic cycle. The company's pipeline extends well beyond its COVID vaccine and antiviral franchise, with promising candidates in oncology, rare disease, and immunology. For Canadian investors looking for a USD-denominated defensive anchor with income and upside optionality, PFE at $26.21 provides a Templeton-style margin of safety. Balanced allocation, SoFi Technologies at $16.17. SoFi Technologies, ticker SoFi, trades at $16.17. This balanced fintech pick is inspired by Howard Marks, the Oaktree Capital co-founder who emphasizes investing at the intersection of quality and reasonable valuation. SoFi is a financial technology company that has been beaten down following the post-IPO hype cycle. The relative strength index sits at 44, which is solidly in oversold territory. Howard Marks would look at this and see a company with strong membership growth, a diversified financial product suite spanning lending, banking, and investing, and a clear path to sustained profitability. The stock trades at a valuation that does not fully reflect its user base growth or its expanding product ecosystem. For Canadian investors, SoFi represents the digital banking revolution that is reshaping financial services across North America. The fintech sector has been out of favor in 2026, but that is precisely when disciplined contrarian investors following the Howard Marks playbook start building positions. Growth allocation, Carnival Corporation at $27.98. Carnival Corporation, ticker CCL, trades at $27.98. This higher growth pick is inspired by Cathie Wood and her focus on disruptive innovation at attractive entry points. While Carnival is not a pure technology play, it is disruptive in the travel and leisure space. The oil crash we discussed earlier is a direct tailwind for CCL. Fuel is one of the largest operating expenses for cruise lines, and the recent decline in crude oil prices flows directly to the bottom line. Travel demand remains incredibly strong, with booking volumes exceeding pre-pandemic levels across the industry. Carnival is also a beneficiary of the bull broadening trade, as consumer discretionary names catch up to the technology sector. Cathie Wood's framework emphasizes investing in companies that are transforming their industries, and Carnival's post-pandemic restructuring has made it a leaner, more profitable operator. For Canadian investors who want to bet on the travel recovery and the oil crash simultaneously, CCL, at $27.98, is the most direct way to execute that thesis. Value recovery allocation, Ford Motor Company at $15.88. Ford Motor Company, ticker F, trades at $15.88. This low-cost value recovery pick is inspired by Warren Buffett's disciplined approach to buying high-quality businesses at reasonable prices. Ford is an iconic American automaker with a global